All right, it's 3 o'clock, so we'll get this going. And to those that might be popping in a little bit later, we're going to be recording these sessions. We always do. And first, I just want to open up by thanking everyone that has chosen to spend their afternoon with us and attend our town hall. Absolutely love doing these. It's something that we all look forward to. And most importantly, with putting this together, is we've got obviously our agenda, which I'm going to touch on that a little bit right now. But we want to make sure that all of your questions are answered because you might be on here attending for reasons that we're not going to cover. So there will be a Q&A we've got at the end, and I'm going to touch on that in a second in terms of what our agenda is. But I'm going to start with an outlook for 2025. And that's basically going to be across the board from a firm update, which I'm going to hand that over to Chris Petty, who is our operations guru in here. We're then going to spend some time talking about a 2025 economic and outlook for the financial markets. And we've got some key themes that we want to address with that. Going to turn over to Ryan after that, and he's going to give us some updates for around taxes that might be important to all of us for 2025. And then Jeff is going to lead the Q&A. And so with that, first let's start with Chris. And Chris, you're going to give us a firm update.
Yeah, thank you so much. And thank you to everybody who's in attendance today. Um, First thing, we're beyond ecstatic and excited to be recognizing a new team member that just joined us. So on your screen, you'll see Raven Caps. She just joined our team, spent the last few years with Vanguard. So a plethora of experience there. And so if you're calling in, she'll be there to help you guys out and answer any questions. And we're going to get up to speed. Just started this week. So we look forward for everybody stopping by the office to meet her as you come in. So really excited for her.
A little bit of background for her. So she spent 6 years rather as a military police officer prior to her 4 years at Vanguard. So she's definitely disciplined and exactly the kind of person that we are looking forward to bringing in an operational capacity. And one thing I'll add to that, if you've noticed, the first two hires that we've made here as the Wealth Stewards 2.0, as we like to call it, have been operational folks. So obviously we brought Chris in October now, November actually, which has been a fantastic ad for us. And we're continuing to make investment in operations because quite frankly, we think that's just a really important area for us to make sure that we're serving your needs as to the highest degree that we possibly can. So we're really excited about Raven.
Yeah, absolutely. And then we'll kind of move into some updates for you guys on the 2024 tax season rolls around for us. So many of you guys would have received an email from myself in regards to some very important information around taxes. So you're going to want to be looking out for two tax returns this year. You'll get one from Raymond James as well as Fidelity. So be on the lookout for those for your 1099s. Those, for some of you guys, have started to see those come into the mail or into your digital boxes, but they will be really pushing on those starting January 31st for Raymond James, and then Fidelity to follow on right around the same time frame, around February 1st. And then those are going to continue to roll out up until the last mailing on March 15th. So just make sure you guys are aware. If you haven't received those, they will be coming into the mail, but you will be receiving two 1099s this year. So definitely be on the lookout, and we're here to assist if we can.
Yeah, that's an important one. This will be the only year where that occurs, but for this year, for many of our clients, there will be two sets of 1099s for any accounts that would generate a 1099, both from Raymond James and Fidelity. So we're more than happy to help walk you through that process should you need some assistance.
Yeah, absolutely.
And now let's talk about 2025 in terms of what that might look like from a market perspective. And we've got three major themes that we're going to cover today. And I'm going to kind of run through these, and then I want to open up to Q&A at the end. If you've got some questions, on the lower left-hand side, you should see a little chat bar there. And you can input your questions into there directly. Jeff is going to be reading those and grouping them in a way that hopefully we can address those all following the presentation. But please feel free to answer anything, whether it has something to do with what we're talking about now or just something else that's going on where you'd like some clarity. But we're looking at 2025. We have kind of three major themes. And the first one we're going to touch on briefly here is fragility. And what that means is this, is that the valuation in the markets and the concentration, particularly in the S&P 500, among some of the big tech names, the Magnificent Seven or the top 10 stocks that are generating a lot of the returns in the S&P 500, have really hit historic levels. And this level of concentration this level of supremacy of American assets, quite frankly, relative to international assets, things are a little out of balance there. We want to, and that's an area that we think there's some fragility in the markets moving forward. We also don't believe that inflation is completely done. Hopefully, it's tamed from the levels that we saw back in 2022, but we still think it's out there and hasn't been completely taken care of just yet. But there are some solutions to that, and that's going to be the second point that we're going to address. It's durability. And we think in terms of building our portfolios, and many of you have already seen a number of changes that we've made across the board in our allocations, we have to be very intentional about what asset classes that we're investing into. And a question that I get a lot and that we all get a lot is the stock market or the bond market or pick any financial market, is it cheap or expensive? And the answer to that is it depends on where you look. If you look at the S&P 500, historically, it's pretty expensive. We're going to show you a couple metrics that support that. But there's value to be found in other places around the financial markets. And so we think that durability, adding some protection in those portfolios, is available at modest costs in the markets today. And the third point we're going to address is something we call the age of alpha. And there's a big debate, and there has been in this industry for a long period of time, of active versus passive management. Obviously, passive management in the S&P 500 has been a fantastic place to be for the last several years. But we have reason to believe that active management, particularly in some smaller, more highly fragmented markets, has the potential to add some serious value. And alternatives also have a potential to add some downside protection to portfolios and then also enhance returns, which we think really contributes to portfolio resilience. So those are the three key points that we're going to talk about to start with. And let's start with this notion of fragility. So what do we mean when we say fragility? Well, this chart's really staggering, actually. We have an unprecedented concentration in the S&P 500 right now of the 10 biggest stocks in the S&P. And so to sort of bring everybody up to speed, the S&P 500, there's give or take, sometimes it's 501, sometimes it's 499, but roughly 500 of the largest companies in the United States comprise the S&P 500. But those companies are not equally represented, we'll put it that way. NVIDIA, for example, is 7% plus of the S&P 500. Apple Computer, again, a giant percentage of the S&P 500. And we're in unprecedented territory where the 10 largest stocks by market cap in the S&P 500 now account for 40% of the value of the S&P 500. And to give you an idea, this is something that we've never seen before. The previous peak that we saw, at least pre-COVID, but then also going back to 1999, 2000, at the peak of the tech bubble, you had the top 10 stocks in the S&P 500 were roughly 26% of the S&P 500, let alone 40%, which is what we've got represented by those big names now. And I know, Jeff, you had a point you wanted to make about concentration.
Yeah, thanks, Brent. We all here have a core value about continuous improvement. I think one of the things that's great is we're all interested in different books and authors. I'm in the middle of Revenge of the Tipping Point by Malcolm Gladwell. And I was listening this morning to part of the book, and one of the things he's exploring is this concept of the genesis and the contributors to epidemics. And there's a concept in there right now that he's talking about that monocultures, right, the homogeny of a culture in any system is what leads to epidemics. Now, I'm not predicting anything, but I think what we really believe about this is one, it's great that American dominance and in particular US large cap stock dominance has happened. But really the question is, what are the unintended consequences and the byproducts of that looking forward? And so I agree with Brent. We've obviously all put our heads around this and thought long and hard about it. And many conversations, people are asking us to allocate more to these types of strategies based off of the last couple of years. Our job as risk managers is to think about that concept about monocultures, potential unintended risks, and in Malcolm Gladwell's term, the potential to spawn unintended epidemics potentially. And I think that's a big job for us. And if you can extrapolate where the book goes and what we're talking about here without predicting anything, I think it's prudent to be careful in regard to this data in particular. So that was my point, Brent.
I think it's an absolutely dynamite point because what you have is you have a lot of money that's chasing the same 10 names. And what we've experienced in the last couple of years is those 10 names have done really well. And we've had exposure through funds or directly through many of them. But what happens if all of a sudden all that those same managers decide they don't want those anymore, and you get a pandemic in those stocks or something like that, or some challenging situations. You get this level of concentration running for the exits at the same time. It's just something that we need to be aware of, and it's something we need to protect with. And what that means is this, and we saw it in spades on Monday. So if those of you that follow the markets, there was an absolute rout in some of the AI shares, particularly Nvidia was down 15 or 16% in one day, and that's because the landscape changed. You had obviously an AI system rather from China that came out, which no one was expecting, that they developed for under $6 million relative to the billions of dollars that are being spent around the world. That's actually really good. And so it begged the question, all right, well, are these the only players now that can deliver on this technology? Now, I won't spend a ton of time on this chart because it's kind of busy, but what it basically means is this. NVIDIA, for example, is 7.2% of the weighting of the S&P 500, okay? And all we're showing you is this, is that, let's say in 2025, these top 10 stocks from NVIDIA to Tesla, all the way down to, say, Broadcom, for example, they return 0%. And the other 490-ish stocks in the S&P 500 return 7%. That means the index is only going to be up 4.5%. If you take it to a more extreme example, if you had, say, the top three stocks, just NVIDIA, Apple, and Microsoft, were all down 28%. But you had the other 497-ish stocks that were all up 7%. All of the return for the S&P 500 is gone. And it's gone because of the underperformance in this example or this illustration, significant underperformance of three of those stocks. So this comes back to Jeff's pandemic analogy in terms of, a couple of these stocks get sick, it really impacts the broader market, specifically when we're looking at the S&P 500. And I think that's a great point. Jeff, you have anything you want to add to that?
No, I'm good. I think you've got it well covered.
That's a dynamite analogy, though. The other thing that we're seeing, aside from the concentration in these 10 biggest names or some of these largest names in the S&P 500, is we have had, and this is another point of fragility for us, a golden age of American dominance when it comes to the equity markets. This has been the only game in town to be invested in the United States really since the Great Recession. And you can see that reflected in a couple ways. Chart over the upper left, for example. This is S&P market capitalization as a percentage of gross domestic product here in the United States. Back around 2000, capitalization S&P was about 127% of the GDP rather, of the United States. We're up to 168%. Again, these are unprecedented levels that we're in terms of just the outsized impact that the S&P 500 as an index has in the financial markets. Now, here's the S&P 500 market cap as a percent of world GDP. Old peak was about 38% or so, 39% back in the tail end of the 90s. We're at 46.2%. Simple way to look at this, if this is going up and to the right, it means US stocks are expensive relative to the size of our economy and also everything else in the world. The third point I'm going to mention is this is the bottom here. And all you need to know when you're looking at this chart is everything that is above this line means that the US markets, US equity markets, outperform their counterparts around the world. We have been in the longest stretch of US equity outperformance since 1977. And there are long periods of time where international stocks outperform, but it's been an unprecedented period of time where US assets, in terms of the size, the scope, just the magnitude of how big they are relative to the rest of financial markets and also the outperformance. It's just been a really, really long time that we have been in this mode. And to Jeff's point, you've got kind of a monoculture here of US only assets that have been really dominating many portfolios. So you've got a couple points of fragility. You've got concentration among a couple key names. You've got this dominance of US assets relative to the rest of the world. Well, is there a way to add durability to the portfolios, add some protection to the portfolios? And I would say that there definitely is. A question that Ryan gets in here, Denise and Kayla and Andrew, we all get in here, is the US stock market, is it cheap or expensive? And our answer to that is it really depends on where you look. Because on one case, we've got large cap US stocks up here, dominated by 10 names, historically by any measure, outsized and fairly expensive. But then that's not the only game in town in terms of the financial markets. You look at small cap stocks, for example. What you need to know when you're looking at this is the spike that you've got around 2008, 2009 means that essentially small cap stocks globally are overvalued. If it's down into the bottom here, into the blue, it means they're historically undervalued. Well, we've got small cap valuations are at 20-year lows right now. And this is really just an example where we're out there looking for value, looking for places where we feel like your money hopefully is going to get a better opportunity to do well for you because we like to buy assets that are not that expensive. Now, another point I'm going to add to this is U.S. assets, the S&P 500 versus the MSCI EAFE. What that is that is a broad measure of developed markets. So think primarily Europe and Japan. This dashed blue line in the middle, this is typical. This is everything's pretty fairly valued, one relative to the other. Well, we've been in this, again, unprecedented period of time where U.S. assets have gotten much more expensive relative to their international counterparts, to the point where we are now, if you're a math wonk, you know what two standard deviations means. It's a big number, it's a big deviance, but we're two standard deviations plus, which is, again, historical overvaluation of U.S. assets versus their international counterparts. And the third thing I'm going to add to that, which is why we've, for the first time recently, incorporated a little bit more in terms of emerging markets into our portfolios, is you see the same thing across the emerging world. You look at U.S. assets, two standard deviations above typical valuations versus their counterparts in the emerging world. And so we think, on the equity side, small cap stocks, international stocks, emerging markets, and it doesn't mean you go crazy adding these asset classes. It means that you, in a very measured way, begin to start putting some money to work in these asset classes, because these are markets that, relative to the S&P 500, are historically pretty inexpensive. Ryan, Jeff, anything to add to that?
I mean, the only thing I'd throw in is, when international turns the corner and outperforms, I don't think it's an if, it'll be a when, as history has shown. It tends to have vast outperformance, and it's a shorter time period of outperformance historically. So, being in front of that feels uncomfortable, but generally is rewarding to people. And so I think that's how we sort of think about, these relative values and relative valuations of these indexes compared to each other. And it's no secret we're comparing most of these things throughout this presentation to the S&P because of our concerns about current valuations compared to historical norms.
It's a great point. So where are some other places you can find some value, you can find some durability? And this, again, what you need to know if you're looking at this, if this line is up and peaking out like it is here, say around 2011, 2012, this means that stocks are cheap relative to high quality U.S. core bonds. If the level is down here to the right that you're seeing, that means that bonds are historically cheap relative to the S&P 500. And this is just another market where you're saying, you know what? If there's a positive thing that has occurred, there's been a lot of positive things that have occurred in the last several years. But we're not that far away removed from the world in 2021 where you could go out and loan your money to the federal government for 10 years, and Uncle Sam would say, that's great, we're going to give you back less than 10% per annum on your money. We're not in that world anymore. There's actually yield to be had in the bond market, income to be generated in the bond market. And again, relative to the S&P 500, we think that there's some really good valuation in core bonds relative to U.S. stocks. And now the point that we're kind of calling this in our mind brain, this is sort of the age of alpha. There's been a big debate across the financial services industry and the wealth management industry about passive versus active. And the truth is we believe there's a place for both. In our portfolios, we've got passive ETF exposure to the S&P 500. We've also got active managers across areas where we think it makes sense. And it comes down to this idea of where can we look to try to generate alpha, which is basically a little bit excess return. So what does this idea, this concept, which is our third talking point about 2025 of age of alpha mean to us at the Wealth Stewards? Well, first, we want to be active in fragmented markets. When it comes to small cap stocks, for example, there is a massive difference in the quality of companies that are listed as small cap valuation stocks from a company that's barely able to pay its bills and some of the best, fastest growing companies that are out there. Teams that are engaged in looking for that value, teams that are living in that small cap world every single day, we think add significant value if they're actively managing that space. I think there's a lot less value to go active management if you're looking at large cap U.S. stocks, just by the S&P 500. History has shown that has worked really well. Same with emerging markets, same with international markets, same with if you're going into mid cap, you're going to real estate, other areas. There's active managers that can look at these fragmented markets, not something as heavily commoditized as the S&P 500. There's an opportunity for outperformance there because these markets, quite frankly, are just less efficient. We also think in terms of building resilient portfolios, this is another idea of age of alpha for us. It means using diversification to manage risk and boost returns. Speaking of this monoculture idea that Jeff has brought up in terms of tipping point, yes, you can just buy the S&P 500, but that's all you own. So if all of a sudden something whips through the S&P 500, there's really very little resiliency that you've built into the portfolio. Third key point for us in terms of this age of alpha is adapting to change. It's adjusting strategies as markets and trends evolve. What's worked for the last 10 years may not work for the next 10. What's worked for the last 20 may not work for the next 20. And this is something we're really actively out there thinking about what are the ways that we can boost returns, remove risk, and do the best job we possibly can for our clients. And a big part of that will be incorporating some of these alternative asset classes and alternative strategies. And we're really in the mode now, both up and down the scale, from liquid alternatives that are pretty much a part of all of our portfolios now, up to private placement alts and everything in between. We're in this mode of embracing these alternatives because we believe that these alternative strategies and asset classes unlock a ton of opportunities. If you just look here in the United States, about 1% of all the companies that exist in this, which is by far the most dynamic economy in the entire world, are publicly traded. The rest exist out there in the private marketplace, and these are areas where we're looking very, very heavily of increasing our focus. So with that's kind of a big picture for us in terms of our three key themes: fragility, that durability, and that age of alpha, and how that's dictating some of the investment decisions that we're making. So now what I'm going to do is just kind of give our overall posture and just sort of try to put a bow on this before I turn it over to Ryan. We think our overall posture coming into this year is this is not a time to reach. This is not a time to go crazy and say, hey, you know what? AI-driven tech has been really great. Let's load up even more on that. Believe me, everyone's got exposure to that. It's impossible not to have exposure to that because it's so broadly entrenched in the overall indexes. So we're not going after that. And we think there's few fat pitches. There's few kind of simple hits if you're looking in that space. We think that there is some risk. It's influenced by factors that sometimes pop in that you're not expecting, like DeepSeek, for example, on Monday. That totally rattled the markets. It's being compared in the tech world to like the Sputnik launch that Russia did, where no one was expecting the Chinese with inferior technology, inferior chips, because we had a ban on some of the best NVIDIA stuff, to be able to develop what they did for as cheap as they did. And there's going to be seismic kind of implications around the entire tech world around that. It's not the only time that's going to happen. And we also think that taking on absolute risk in some of these areas where a lot of money's been piling into that is not all that attractive when you have valuations that are already at a very full level. Inflation, I think this is less of an issue here, but I don't think we're done with this. I think inflation, I don't know that we go back to the Fed's target rate of 2. So we want to prepare for a world where maybe it's 3 to 4. Maybe this inflation environment looks a lot more like it did all through the 1980s and less than it did during a historically low period of inflation like we had, say, 2008 to 2020. And there's also the opportunity for different geopolitical uncertainties that can multiply, that factor that could cause price discrepancies to occur throughout the system. And we definitely want to keep an eye on that. From an allocation standpoint with all of our clients, the number one concern is that we're aligning your risk with the ability to take that risk. Because our main goal in here is we want to take the absolute minimum amount of risk that we need for you to meet and achieve your goals. And so we've got to align that risk with first of all, what you need, but also your ability to tolerate that level of risk. And in terms of building portfolios, we want to prioritize a durable return, which includes adding in some of those assets that may be out of vogue relative to the last couple of years. We want to be mindful that there could be a surprise on the upside of inflation. We want to take that into account in our valuations. And we want to lean on this concept of alpha, looking to markets that are more fragmented, where some active management may make sense, looking at some alternative strategies and asset classes to help us build more resilient, stronger portfolios. And so with that, I'm going to turn it over to Ryan, and he's going to give us some updates for 2025 around taxes, which is, of course, something we all love talking about.
Yeah, thanks a lot, Brent. So Brent got to do all the fun stuff. I'm going to talk about taxes, which no one wants to hear about. So first off, just looking at the federal tax provisions for 2025, standard deductions versus itemized. And we've got a deck on this. So if you have tax questions, feel free to reach out to Jeff, Brent, or myself, and we'll get you a full deck and answer any questions you've got. Not many changes here with standard deductions versus itemized. Of course, you want to be cognizant of net investment income tax and Medicare surge tax. The next slide here, we're going to be looking at your income levels for the year coming up. So if we can get to that next slide. Really, you want to just know if this year coming up, if you think this is going to be significantly more income or significantly less income, things you can be doing and planning around that. So these are things we would ask you to proactively bring up to us. if we're not aware of the situation, if there's something specific for you. And so there's things you could be doing around that. So if you've got a year where you're going to be earning more than you're used to, things you could be doing is accelerating your itemized deductions. Think here of charitable deductions that you could be taking in this year. And then if your income's lower than normal for some reason, maybe it's a good time for us to be considering doing Roth conversions for you, things like that. So areas where we could be planning around things you should be aware of. And then next, just taking a look at things that are new for 2025, areas you should be aware of. So the 2017 Trump tax cuts, those are set for sunsetting at the end of 2025, but maybe you were paying attention late last year and we had Republicans take majority in the House and the Senate. And so with that, we would expect that they're going to attempt to extend these. So there's a good possibility that those tax cuts aren't going away. Another opportunity for you is the lifetime gift tax exemption. Again, 2025, we saw another increase, 380,000. So your new lifetime limit's at 13.99 million per person. And if you had maxed out lifetime gifting before, there might be an opportunity to where you have some that you can do here. So things to be cognizant. And then last, there's a super catch-up that has been added starting as of this year. This does not have a sunset provision. So this is something that if you're under 63, you should be aware of. Ages 60 to 63, you're able to stuff some extra money into your retirement plans, reduce your taxes. So that's a interesting thing to be aware of and know, if you're used to maxing out your 401ks, you've got an opportunity to do a little bit more there. So
Who says getting older isn't fun?
And with that, Jeff, we're going to turn over to you for the Q&A. You get to answer all the questions now.
Yeah, so first, because all of you are, as participants on the call, are muted, and we don't want to sow chaos into the environment by unmuting everybody. Once again, there's a Q&A button. We have 3 questions lined up so far, but anybody who has any topic relevant or tangentially relevant to what we've talked about, feel free to ask questions. You can ask questions about the firm. You can ask questions about staff, operations, anything. We'll do everything we can to answer it. And so please use the Q&A feature, and we'll get into them. So 3 racked up so far, which seems a little light, but we'll try and tackle those, and maybe the answers to these questions will stimulate more. The first one, and I throw it up for all 3 of us, Ryan, Brent, myself, is how do we think about hedging strategies? And I think this question came out early on, particularly around the valuation of large cap and the preponderance of U.S. investors in particular, maybe to own a larger swath of U.S. stocks than perhaps the rest of the world or us as risk allocators would want. So anybody want to take a stab on hedging strategies and what that means to us and how we think about it?
Yeah, I'll jump in on that to at least to get the conversation going. Is I think the hedging starts with the allocation, and you're hedging away the outsized risk of being in those 10 stocks or being super overweight in the United States by just quite frankly not having that degree and that level of exposure. The other thing I think is really important to note is as we've been incorporating a lot of new investment strategies into our portfolios, this idea of alternative asset classes, alternative strategies that look and act very different than just long U.S. only, long fixed income. In many cases, they will zig when other markets zag. For example, many of you are seeing these incorporated in your accounts right now. But if you have the managed futures accounts, for example, or funds, for example, back in 2022, which was a really challenging year as an equity investor and also as a bond investor, actually did quite well because they don't necessarily their performance is not tied to a directional bet. It's tied to underlying volatility or underlying price discrepancies. And I do think we're moving into an environment where you're going to see those price discrepancies potentially increase, where you'll see that gap that has opened up so big between U.S. assets and international start to potentially do this. Small cap and large cap do this. And so I think the first thing is, from a hedging standpoint, is not to be necessarily following the crowd and being as overweight in what we think are these overvalued asset classes, and also adding in other strategies that don't behave the same way in several different environments.
Yeah, and I think I'd add to that, when you've got valuations this high, this is really the time where we want to do more in this area of hedging, right? So, you know, the trade-off with having that passive investment strategy and being just strictly in the S&P 500, the reason you don't want to do that, it's as simple as we always talk about diversification. And by being properly diversified, you are hedging, right? And so we've started implementing within the portfolios real assets and hedging strategies. Think here of, you know, what you see with hedge funds. They've made this available in mutual fund wrappers, and we've been adding things like this to the portfolio specifically for this reason. Valuations keep going one direction, and we think it's prudent to hedge some of that risk.
Yeah, the only thing I'd say is, I celebrated 25 years in the industry back in October, and one of the lines that landed with me a very long time ago is that asset allocation, diversification is a conscious decision never to make a killing in exchange for never getting killed. And we've used that as a guidepost for a long time. We have significantly altered and enhanced the asset allocation suite of products that we have you all accessing at this point compared to our prior tenure at Raymond James. That was, after all, one of the reasons to come onto this side and bring you all with us, which you all thankfully endured all those changes last year. Now, what we really hope is with these thought processes in place inside a portfolio and these decisions made, we can let these things really come to light in an environment that might not be as easy as 23 and 24 in terms of overall returns being driven from these equity valuations, particularly S&P going up. So hopefully that helps. And the person who asked that question, we're always happy to dig as deep as you like one-on-one afterwards as well. So another question, I think very thoughtful, view on interest rates, and in tandem with that, what's the expectation for inflation? Does it reemerge in light of policies, particularly with the new administration?
I can dive into that too, Ryan, unless you want to take a first stab at it.
I'm happy to if you'd like. Yeah, so just looking at interest rates and how those are playing in with inflation expectations. So there are certain policies I'd say that this administration has talked about that if actually executed would be inflationary. One of those is if you see tariffs en masse, and we think about tariffs, that's a cost to bring goods into the United States. From that country, whoever's bringing those in is paying that cost, and ultimately that cost gets passed on to whoever's purchasing an used product. And so there's no way around it. That is inflationary. Whether or not we actually get that, though, is still up for debate. We haven't seen anything significant. There's some small talk over the weekend of something with one specific country, but it's not en masse. And so at this point, the market isn't pricing that in. But if you saw that, that would be inflationary. Another one is if you have mass deportation, you're going to have pressure on wages at that point, right? If you've got less individuals, now wages are going up for the remaining participants in the labor force. When people have more money, what do they do with it? They're going to spend it. And so if you've got more dollars chasing fewer goods, again, that's going to be inflationary. So these are things that we're keeping an eye on. We wouldn't say that it's an inevitability that these happen. But if they do play out, those are areas where you could see inflation come back. And so that's the big question, right? Is you had rate cuts, but you really didn't see that play out in the longer end of the yield curve yet. And so why is that? There's a lot of speculation as to why it is. We don't know the answer yet definitively, but it's something we're watching.
Yeah, and there's something I'd throw in as it relates to interest rates, and what that equates to is the difference between what the Federal Reserve is signaling long-term Fed rates are going to and what the actual market is pricing in for them to go to. So the market's saying, or the Fed's saying, well, we're going to get rates down to 3%, yet the market's saying they stay closer to 4 for the next 3 to 4 years. And so what that means is, the Fed's trying to signal. I think one of the interesting experiments that history will sort of judge us on is, back in the 1980s, the Fed never did press conferences after Fed rate decisions and then signaled what they did, why it did for the market to react to. And what it's done is it's led to more and more speculation. I think it's an unintended consequence. I think it was a good-natured attempt to try and explain themselves. But again, nothing comes without repercussion or reaction. And so it's interesting to see how little the market believes the Fed right now. And so I think there's a lot to be determined about what is bluster, what is feasible, and where this all lands in terms of where rates end up, where inflation ends up, what policies are actually sticky as opposed to negotiation tactics and whatnot by the current administration. So hopefully that answers that question. And we're going to move on to one less market sensitive and one more related to internal stuff. So question came in, congratulations to Raven for joining the team. Why did we as an organization make 2 consecutive operational staff hires for our first 2 hires since the merger and move from Raymond James? And then a follow-up, are there any additional hires coming?
I think we can, I can take a stab at that. I think that one of the things that we've recognized is that really making sure that everything is done for our clients in a timely manner, a speedy manner, and accurately is hugely important. I also think that with the growth that we've had, for Jeff and I partnering, and fortunately having Ryan come with us as well, has added for sure a level of complexity. Now, the positive byproduct of that is, if you're from my legacy team, for example, you had myself, you had Kayla, you had Andy that took care of a lot of different things. And now that we're part of a larger entity here, we've recognized that Kayla, for example, has a very different skill set than Andy. Andy has a very different skill set than myself does. And we have the ability to really use people in what we think is their highest and best purpose within the firm. Now, part of that is we realize that, again, from an operational standpoint, all of this stuff that we're talking about in terms of investing the money, in terms of out and growing the business and doing all the things that we're doing, none of it matters if you can't execute on it. And a huge part of the execution is really the unsung heroes of this business are the people that are handling all of the operational things that are happening behind the scenes. And it was really important for us to get that locked in and operating at the highest possible level that we could. And we felt that bringing in 2 dedicated operations people was a phenomenal first step to do that.
Yeah, and I think the thing I'd add there is, something really exciting. When we bought our home last year, many of you have been here, and we renovated the downstairs, put the teams together, really got ourselves settled. And then once we got here, we were able to assess, who's really good at what. And you can see that's the journey we're on now to make sure that people are doing, what they're best fit to do inside of the scope of what we provide for you in services. And the other thing that we didn't do last year was build out the upstairs of the Wealth Stewards. So if you don't know, there's a staircase when you walk in, and upstairs is another almost, I think, 1,700 square feet. And we left that alone, not quite knowing what and if we were going to do something with that space. I think Brent and I's first swipe at it was, well, probably in 2 to 3 years, we'll figure out what we want to do with that. What we have found is that even as we sit here today, we have other people in the business who are interested and attracted to what we're doing. We are being highly selective in conversations with people. But we do anticipate that there will be more team members of the Wealth Stewards. Mostly, though, those team members will have limited to no impact on the people on this call. In that, if we can build additional capacity with additional talent, that is to handle additional growth of the firm largely. And so, we're kind of doing a couple things at once. We're trying to make sure we right size and have the capabilities, the technology, the support for you all. And Brett and I and Ryan and everybody here have a core belief that, if we're not growing the business, it's not a good sign for the business. And so we'll continue to spend some part of our mind share, wallet share, and capacity to build out those capabilities. So I apologize if anybody comes in for a meeting over the next month or two and there's hammers and noise. We'll try and make sure that doesn't happen. But that is a sign of additional growth of the firm, which is exciting to us. and really is the sign of a healthy business, which is what we want for all of you along the way, not just today, but in the future. All right, another question. I think this one is back to sort of market questions, which I think is another good healthy thing to attack. Aren't small caps more interest rate sensitive? And I think this question came in reference to large caps and potentially to interest rate environment and where that's going. So anybody have any comments on small caps and what we're thinking and why we're thinking it and how they might play out?
Yeah, I think that historically there's been that belief that small cap stocks are more sensitive to interest rates. And I think there's some truth to that because you've got, generally speaking, these big giant companies that comprise the S&P 500s, generally they're sitting on stockpiles of cash. And so higher interest rates are benefiting them because they're getting a return on their cash, which is a good thing. A lot of companies that are smaller and faster growing, they've got to access the capital markets. And so that can be a little bit of a stretch for them. But I don't know that you're going to see some of these historical, I guess, historical uh, alignments continue indefinitely because you do have, one of the byproducts of this real push to onshore, which has been happening long before this current administration. It was happening and accelerated also under Biden as well. Is generally potentially a very good thing for smaller companies here in the U.S. If you're onshoring some additional capacity, you've got to have other companies and infrastructure around to support that. I also think that what we saw, for example, with the news that came out, yesterday out of China, is that a lot of these massively disruptive technologies that come out, they start with small companies. I mean, if you look at the Amazons and the Nvidias and the Googles and let's to a lesser extent Apple, and Microsoft, but a lot of these biggest, most powerful companies that we have right now, in the scheme of things, are not really that old. And they started as small cap companies. And if you look back at the history of industry here in the United States, many of the most powerful companies were started during periods of economic dislocation or where things got shaken up a little bit. So I think it's an area that there's a little more interest rate sensitivity, but the ability for really explosive growth down the road, I think, is way higher for a company that might be in that small cap space than it is for a company that's already worth $2 or $3 trillion.
Yeah. I would add to that as well. When you look at these valuations and you've got small caps at a 25-year low versus your large cap companies, that is the reason, right? We've already had the move in rates. You went from effectively 0 to over 5 and back to where we are now. And so all of that pain, they've already prepaid that, right? That's already occurred. And so the person asking the question, you're dead on. That's why though, right? So they've already taken that hit. And we think you're at a point now, if you go from 4 to 5, that rate of change is not significant enough to impact small cap valuations from here.
Yeah,
Already taken it all on.
I'm going to throw one more thing in there that's really interesting. I'm looking at a slide deck on my other. I'm kind of cheating. I'm looking at a slide deck from JP Morgan on my other screen, but in particular, the earnings growth is what drives additional pricing power for a company. So if you look at 2023, the earnings growth of U.S. large cap was 0. Okay. Mid cap was 10%, but small cap earnings growth, to Ryan's point, in 2023 was negative 12%. And in 2024, forecasted going into fourth quarter, it was going to be negative 13. Now in 2024, large cap earnings growth was positive 9. That's a 22% delta between large and small cap. If you look at the 2025 forecast, the forecast is for small cap earnings growth year over year in 2025 to be up 44% and large cap to be up 14. So there's an acknowledgement that between valuation, Ryan's point about interest rate hikes largely being absorbed, there's excitement about small cap and the innovation that exists in there to have some of its value realized either through, interest rates maybe not being higher, but not, excessively so, or what happens in small caps, they just get gobbled up and they get gobbled up at a premium. And those things based off current valuations can be tremendously exciting. So hopefully that answers that question. And on to another one. One other question, just in general, without, what do we think the best opportunities are for our investors and all investors as it relates to 2025 and perhaps beyond? I mean, markets don't care about calendar years for the most part. So today's best opportunities, maybe a quick hit from you guys, and I might have one too if you miss one.
I would say with that, I think, U.S. equities, of course, and the traditional assets that we're invested in, particularly in the equity side, have really always driven the growth, whereas the fixed income piece has driven the income component of that. But I think if you're looking at where to invest money, if you are a business owner, and we serve a lot of them, you invest in your own business as well. You invest in outside companies for sure, but investing in your own business. And I think that private equity to me is a really fantastic opportunity because you get the ability to invest in other people's businesses that are not necessarily that have already been that have not already been discovered or publicly trading in the market. So I would start with U.S. stocks, your own business if you're a business owner, other people's businesses because there's the ability to do that now. And I'd say then real assets. To me, those four buckets can do a lot of good for you over a long period of time.
Ryan, anything from you to layer on top of that?
No, I think that's great summary.
Yeah, I'd say the interesting thing to me, again, on the valuation differential, at some point, it becomes just a compelling case just because of how cheap they are. That some, not all, but some of these international companies who derive revenue from global operations are just so darn cheap. And so you wonder, where is there a place, again, as we said earlier, for some active management? Active management is a brain sifting the wheat from the chaff in a market segment, in a sector, in a geographic area of the world, and saying what makes sense here. And so those can be things like a play on India's emergence of their middle class, AI, manufacturing, and I think what's been proven, people always ask us, how can the S&P 500 or, equity markets return 10% over 100 years and hundreds of years annually? And you say to yourself, because capitalism and the way that markets work and the ones we invest in have a survivor's bias, right? And so indexes and companies that grow and do a really good job can be identified. There are parts of the portfolio where it makes more sense than others. We take on all of that work for all of you. And I hope in answering all these questions, at least what we've shown you is, it's not just one brain attacking these problems. It's not just three brains attacking this problem. It's a large segment of brains inside of the Wealth Stewards and then partners outside that come to this. And if you need any more detail, any more color, any more evidence of where we get these ideas, we're happy to have those conversations in your reviews, on calls, or via email and reply to that. So thank you for all the questions. If there's anything we didn't get to or you're too shy to ask, find us afterwards. Brent, I'll turn it over to you.
Again, thanks everyone for joining us. To Jeff's point, any further questions, email any of us directly, and we're happy to expand on these conversations. But again, this is something that we intend to do every quarter to keep you up to date and keep you up to speed with what's going on and what we're seeing out there. And to the fact that you took some time out of your afternoon to spend it with us is deeply meaningful to us. So thank you all very much.
Have a great day.
Thanks a lot.